For the past 40 years, the rules for investing have felt, well, simple. You just buy the market, hold on, and let the magic of compounding do its thing. But what if that's not the game anymore? What if the market itself, the very thing you trust, has become the single biggest risk in your portfolio? And what if that index you think is a diversified slice of the American economy is really just a massive concentrated bet on one single speculative idea? We're going to dig into the math, we're going to follow the money, and we're going to lay out a totally different playbook for what could be coming next. So, let's just get right to the heart of it. You own an S&P 500 index fund, like SPY or VOO, because you've been told it's the safest, most diversified way to own a piece of the entire U.S. economy. It's the bedrock of modern finance, right? But is that belief still actually true today? Okay, take a good look at this chart, because it's not a typo. Right now, a full one-third, 33% of the entire S&P 500's value is crammed into just 7 companies. Let that sink in for a second. Every time you buy the market, 33 cents of every single dollar is going into just a handful of giant tech stocks. The other 493 companies? Yeah, they have to fight over what's left. Folks, this is not diversification. This is a momentum fund wearing a trench coat pretending to be a safe index.
So, to really understand how we got here, and more importantly, where the capital might be heading next, here's our roadmap. First, we'll shatter the S&P 500 illusion. Then, we'll look at the great market bifurcation that's splitting the economy in two. From there, we'll actually build a portfolio for solvency, explore a much smarter way to hedge the AI boom, and finally, track the new rules of capital by following the institutional money.
All right, let's start with this illusion. See, the real problem is that the market isn't a proxy for the broad American economy anymore. Not even close. It has morphed into a leveraged bet on a single powerful theme, the artificial intelligence capital expenditure cycle. The futures of hundreds of different companies are now chained to the spending decisions of just a few. And this is where the hidden danger really is. In a healthy, diversified market, if one company messes up, it's just a small blip. Who cares? But today, if a single giant like NVIDIA or Microsoft just slightly misses expectations, it has the power to drag the entire index down with it. The risk that used to belong to one company has now become the risk of the whole system, especially for anyone who thinks they're playing it safe with a passive fund. Now, this massive concentration didn't just happen by accident. It's the direct result of a fundamental change in our economic world, a great bifurcation that's literally creating 2 separate markets, and maybe even 2 separate economies that are operating under completely different sets of rules. For 40 years, from about 1982 all the way to 2022, we lived in this wonderful period called the Great Moderation. It was a world where interest rates and inflation only seemed to go one way, down. And that was the rocket fuel for stock valuations, especially for tech. Well, that era is over. We are now in what you could call an era of fiscal dominance, where huge government spending is keeping inflation sticky and the cost of capital, the actual price of borrowing money, is a real thing again. The playbook that worked for the last 40 years isn't just outdated, it's potentially dangerous now. And this brings us to a critical history lesson, a parallel that should honestly give you chills: the dot-com bubble. Look, the internet wasn't a fad. It absolutely changed the world. But if you bought shares in Cisco Systems, the company literally building the backbone of the internet at its peak in 2000, you lost 89% of your money. It took you 20 years just to break even. The technological revolution was real, but the investment thesis at that price was a fantasy. So fast forward to today. The AI revolution is absolutely real. And the price tag to build it? It's staggering. We're talking an estimated $5 trillion to build the data centers, the GPU farms, and the power grids to make it all happen. But here is the massive risk. If the profits from AI don't show up as fast as that money is being spent, we could hit what's called a Capex Air Pocket, where all that spending just collapses because the return on investment isn't there. It's the Cisco parallel, but on a global multi-trillion-dollar scale. So, if the old playbook is broken, if you can't just blindly buy the index, what does the new one even look like? Well, it requires a pivot. This next part is all about building a portfolio designed for solvency, based on a simple, powerful idea that Wall Street basically forgot for a decade. Cash flow is the new king. This really is the whole paradigm shift in one slide. We are moving from a world of growth at any price, let's call it GAAP, which was fueled by free money, to a world of cash flow at a reasonable price, or CARP.
For the last decade, you could invest in a company that promised profits maybe 10 years down the road. But now, in a world where capital actually has a cost, the companies that are generating real, tangible cash today, they become the most valuable assets. It's a fundamental shift from pure speculation back to solvency. So how do you actually build a portfolio for this new world? Well, it starts with a couple of core ideas. First, you need a ballast, a stable core of high-quality companies that aren't picked for hype, but are screened for real things like strong free cash flow and a high return on equity. You're owning actual businesses, not just stories. The second piece is about taking the market's growth and actively transforming it into real, spendable income, using clever vehicles that can actually buy the market at a discount and are built to pay out cash. And around that core, the strategy gets built out with some very specific themes designed for today's economy. It's about monetizing the insane volatility we see in tech, literally earning an income from the wild price swings instead of just being a victim of them. It's about owning real, tangible assets that provide leveraged income, like critical real estate and utilities. And maybe most importantly, it's about hedging against the sticky inflation that's not going away by owning the hard assets that are the bedrock of our physical world: energy, gold, and raw materials. Now, I have to be crystal clear about something here. This strategy is not a bet against artificial intelligence. Not at all. In fact, it's the exact opposite. It's a bet on the physical, tangible, real-world stuff that is absolutely 100% required to power the entire AI revolution. These numbers right here tell the whole story. The broad S&P 500 is trading at a historically pricey 21 times forward earnings. Basically, perfection is already priced in. But the utilities that are needed to power all those new AI data centers, they're trading at around 16 times earnings. And the energy companies that are fueling those power plants, they're going for less than 10 times earnings. That gap in valuation, that is a massive margin of safety. So here's the key takeaway. You're just shifting your bet. Instead of paying an insane premium for the high-flying tech stocks and just hoping they figure out how to monetize AI perfectly, you are buying the essential inputs for that revolution at a serious discount. You're betting on the electricity that the data centers absolutely have to buy, the copper they need for wiring, and the energy to run it all. You are owning the physical collateral of the digital revolution. Look, fundamentals and valuation, that's one piece of the puzzle. But if you really want to know what's coming next, you have to follow the capital. And there are some very large-scale money flows happening just beneath the surface right now that suggest a big change in market leadership might already be happening. You've got two giant forces at play. On one side, you have this blind passive flow. Every 2 weeks, your 401k money automatically buys the biggest companies in the index, no matter the price. It's a price-insensitive momentum machine. But on the other side, you have the institutional smart money, and they're quietly making moves. Major funds are trimming their top-heavy tech positions and rotating into strategies built on carry, which is just a fancy way of saying they want to own assets that pay them more than it costs to hold them. They are setting up for a world where yield matters just as much as growth. And there's a force moving through the market that's even bigger than institutional funds: demographics. 10,000 baby boomers are retiring every single day in America. This is a tectonic, non-negotiable shift. Think about it. Retirees don't live off of stock appreciation. They live off of cash income. And that creates a massive, structural, decade-long wave of demand for the exact kinds of assets we've been talking about: stable, income-producing businesses. And what this all leads to is a portfolio with a really attractive payoff structure. It creates a powerful asymmetry. If the AI boom keeps roaring and the economy flies, this portfolio will do just fine. But if the economy stalls or the AI hype cools off, the valuation support and the steady cash dividends provide a powerful cushion. The entire structure is built around that classic investment principle: heads I win, tails I don't lose much. So this really leaves us with the one crucial question that every single investor has to answer for themselves right now. What is going to define the next decade of investing? Is it going to be a repeat of the last one, a belief in growth at any price? Or are we going back to fundamentals, a world that rewards real cash flow at a reasonable price? And I think the answer to that question lies in one simple truth. For about 15 years, capital was basically free. Now, it has a cost. And in this new world, the ability to fund your own operations, to pay your debts, and to return cash to your shareholders without needing the market to be in a good mood, in other words, solvency, that is the ultimate, unassailable competitive advantage. So let's just quickly wrap the key takeaways. First, the S&P 500's diversification is basically an illusion now. It's a concentrated bet on big tech. Second, the entire economic regime has shifted, one that favors real cash flow over speculative growth stories. Third, a portfolio built on real assets and value can actually hedge the risks of AI mania without betting against the technology itself. And finally, both the smart money and the unstoppable force of demographics are signaling a major leadership change could be underway. Look, most people just watch the markets. This channel is about understanding why they move. If you want to stay ahead of that curve, you know what to do.